Hello everyone, welcome to this week's edition of the Weekly Wrap-Up. The week gone by was a positive one for the Indian markets, with the Nifty 50 ending the week higher by about 1.4%. Large caps and mid caps were up by about 1.1 to 1.2% from a week ago. However, small caps did well with a 3% move in the index. When gauged from a year ago, the small cap index is up by about 10%, while mid caps are up by just about 2%. Large caps, on the other hand, are up by about 5.5%. When compared to their 52-week highs, small and mid caps are down by about 15 to 16%, while large caps are down by about 11%. Coming to some of the key news in the week gone by, the Indian economy expanded at its slowest quarterly pace of 4.1% in the last year. This was largely due to the war situation in Europe, which had its impact on the global economy as well as on commodity prices and the overall demand. The third COVID wave also had its role to play. With this, the GDP growth for the full year ended FY22 came in at 8.7%. Going by forecasts, India's GDP is expected to grow by about 7 to 7.5% for FY23. Another key news that hit the market towards the end of the week was that of India's largest cement company, UltraTech, announcing its capex plans of 13,000 crores to take up its capacity to 159 million tons. Its current capacity stands at 120 million tons. This number includes its ongoing capex as well. This development came a few weeks after news coming in from the Adani stable of the ambition of ramping up capacity aggressively and targeting industry leadership post the announcement of its acquisition of Ambuja and ACC assets. Going by the market reaction post this announcement that was made on Thursday evening, there was a weakness seen in cement stocks, especially the mid and large cap names such as Dalmia, Ramco, JK Cement, Birla Corp, and as well as UltraTech, which all fell by about 5 to 10% on Friday. Now, what makes this interesting is that this is happening at a time when the cement sector is facing cost pressures in the form of higher input costs as well as freight costs, which are putting pressure on the profitability. On a YOY basis, profits of cement companies that are part of the NSE 200 index were down by about a fourth in the recent quarter gone by. Not to mention that it seemed that price hikes taken by the cement players in recent times were also largely getting absorbed by the market, which is indicated in the revenue growth that happened in the quarter gone by despite flat volumes in the quarter. However, with this announcement of the large two players getting aggressive with their growth, aggressive pricing scenario cannot be ruled out for the future. Having said that, we took a quick glance at the valuations of the cement names. Now, given that EBITDA or earnings before interest, tax, depreciation and amortization of cement players are under pressure and will likely remain so in the coming quarters as the high cost inventory gets absorbed, we thought it would be better to take a look at a more economic cycle neutral metric such as the price to book value instead. And gauging this data for some of the largest cement names, they do seem to be trading at the lower end of the price to book value band of the last decade. UltraTech, for example, is trading at a shade over 3.2x. But going by the data of the past decade, the stock seems to have bottomed out usually at about a price to book value of 3 times. So this does imply that valuations are attractive despite the near to medium term inflationary pressures. The easy absorption of the price hikes indicates that sector or at least the market leaders in the sector do have some leeway to pass on incremental costs that are expected. In addition to this, the long-term demand outlook remains robust as well given the focus on infrastructure and housing in the country, which would help support the demand for building materials including cement. Therefore, in our view, a decline in prices gives an opportunity for bargain hunting in the sector that can help building wealth over the long term. That's it from us this week. Thank you very much.